A quick stop on the way to the meeting. Chris didn't have a memory card in his camera.
That was an expensive mistake. This episode cost me now $25,000 and $45. I gotta go back in and cut this.
Seriously?
He who does not risk never drinks champagne. That's what the Russians say, at least. And today, we're not drinking champagne.
We're talking about a company that we invested in and lost our entire investment in a few months.
We invested $75,000 in a startup, and 60 days later, it's gone.
And we all know that the majority of startup businesses fail.
So we're gonna go see Steve Gilman today from Block Party and talk a little bit about what happened to his business. So they'll go and set up your tailgate. You just show up, you eat sausage, you drink beer, and you go to a football game.
We invested on April 18th. By July 18th, the company was going out of business. We all love talking about our successes, but sometimes we learn the most from our failures.
What happened to this investment really shook us.
So today on Dumb Money, how did this happen? Where did we go wrong?
And how do we make sure it never happens again?
I think full disclosure and transparency is very important. We posted this video on February 12th. We actually made our investment on April 18th. On July 18th, we received an email with an investor update. We do not see a viable path in order to continue operations, as we're on a path to sell most of our valuable assets and close down operations.
When you invest in 20 to 30 early stage companies a year, things are going to go wrong and you're going to lose money.
We essentially thought investing our $75,000 would help them extend the likelihood of becoming a successful business. Apparently that didn't work.
What could we have done differently?
Two things you're investing in with an early startup company: the founder and the idea.
If he can raise the rest of the round, we'll be the last investors in.
So this was our very first meeting with Block Party. We did several follow-up meetings. We got deeper into their business model, deeper into which contracts they had with which schools. We thought this had a chance of being a huge success, and it really comes down to risk and reward. In this case, they were running out of money, and they had these contracts that would pay off over 2-3 years. We're making relatively small investments in very high-risk startup companies, hoping to have a 10 times or 50 times or 100 times return on our investment.
Trust, and that's what's not written down anywhere. There's one other player in the market. Business model's different because they do it with rev shares with the athletic department. We do it through sponsorship, which scales quicker, and it gives us marketing assets. Each one of them is exclusive.
And that's the thing. They had these exclusive agreements with the schools, with the athletic departments, with the people who actually control the real estate on college campuses to allow tailgates to happen. They were going to be the exclusive vendor. They were the exclusive vendor. I wonder what we were thinking at the time.
At the end of this episode, we better be walking away smarter.
The terms of this deal, it was a convertible note, which is basically a loan that converts into shares of the company at the time the company is sold or there's a liquidity event. And our discounted purchase price of those shares would be the lesser of 80% of the price paid per share, with a $15 million fully diluted cap. We valued this company at $15 million. So looking at the schedule of investors at the time, they didn't raise $2 million, but they did raise $1.43 million. And that was before we invested. And with that signature, my fate in this deal was sealed. So today, a follow-up meeting with Steve Gilman, co-founder of Block Party. Words of wisdom for us?
Gosh, I'm at a loss today.
This was a remarkably quick turnaround for going from doubling or tripling our money, and within 60 to 90 days, it was worth zero.
The second I heard that the deal was going south, I instantly thought it will be a really expensive episode, a learning episode for us and our subscribers.
You
What
guys
not to do.
get something out of it.
Well, we get something out of it too.
Yeah.
We get some learning. It just, we had to pay $25,000 each of learning. You guys just have to sit through a 10-minute video.
So far, in the past 12 months, I've invested $1,005,471.58 in startup companies. I'm rethinking this whole thing. I think I might start investing more in stocks and less in startup companies, but the reality is, it's all about risk and reward. Startup companies give you the very, very high risk, good likelihood that the startup company will go out of business, but also the chance at a very high reward, the 10 times, 50 times, 100 times your money, that's very hard to find in the stock market. It's very hard to find anywhere, but startup companies is one place where that is at least possible.
The one thing that I think everyone needs to understand about Block Party is that our rationale for investing was that they had a deal on the table to essentially acquire the company, like over time, and they were going to get a few million dollars up front, and then as they hit performance metrics over the next 2 years, the company was essentially going to get acquired for 2 to 3x what we were investing at.
Yeah.
So we had pretty good faith in that team to hit those benchmarks. Here's what I'm going to ask Steve, the founder, today. And he's been great, by the way. This is what I love. Like, if you're gonna lose your money, at least as a founder, stand up and do the right thing and continue to communicate with your investors. And he has been so transparent with us through this process, and I really appreciate that.
Sure.
This guy is gonna go a long way.
Not much of a show, is it?
I know.
What's
up, dude?
Hey, how's it going?
Block Party Part 2, final chapter. Very brave of you. I know you're not going to want to do this, but we're all about actually extracting value out of every experience we have, good and bad.
Thanks for having me, first of all. I'm here under my own will. Lessons have been learned. I can now reflect and start drawing all those lessons.
From an investor standpoint, what do you think we could have done differently if you were in our shoes back then?
In terms of what to do better, and I've thought about this on both sides, maybe we can draw some of this stuff out a little bit, because I don't have a perfect answer. So the situation was this. We had a vehicle for $3 million plus another 6 on a line of credit. So $3 million off the bat. And the $3 million, you guys got to it pretty quick. So did we, so did the investor that we thought was coming in big. By the way, we've been with this group for the past 2 years doing great work with them.
And now I know why I was so confident in this, because it wasn't like a random company said, yeah, we'll come in and give you $3 million, and then they find things out, right? They knew who you were.
Yeah, you'd already been doing business with them.
Oh yes, multi-million dollars of business. The only reason it took till last year to start talking about investments is because they were doing a merger with their biggest competitor. I mean, there's no question that we got lammed.
In retrospect, you don't think they ever had the intent to complete the acquisition. They were trying to get information, right?
We don't know all the story, which is the sad part. I actually don't think that they were trying to leverage us to do this from the beginning. I think an investor from another company stepped in and got in the way.
I don't know that there's much more that we could have done.
Yeah, I think we knew the risks going in, so that's why I'm comfortable with what happened.
I think it's fair to say that even when it looks like it's a lock on a deal, it's a sure thing, there's really never such a thing as a sure thing when it comes to mergers, acquisitions, company finances, closing on investments, right? There's so many factors at play. There's more factors than you can even imagine. There are factors from outside the company, an economic collapse, a geopolitical issue. There are so many things that can go wrong. Maybe the biggest takeaway here is really being honest with yourselves in terms of the risk of what seems like a sure thing.
It's great that you voluntarily came to this and knew that we'd have cameras rolling. It says a lot about you as a founder and, you know, just as a person.
I appreciate that. And 2 months ago, I wasn't smiling, I wasn't laughing. I was trying to figure out, in the moment, what could I do? What could I have done? And now I look back and say, you don't flirt with monopolies in the market, and there's strategic moves, and maybe taking care of shareholders is signing a doc today instead of wait. You never know.
Well, I think getting yourself into a business where, like you said, where there is a monopoly, where you have a binary, it's either this or nothing, is not a good place to be in.
That's going to do it for today's Dumb Money. Thank you guys so much for watching. We hope you learned something. If you did, smash that like button.
If you like this episode about us losing money, make sure to watch our other money losing episode with
It's called Failures.
And if you can think of something that we should have done differently, let us know in the comments.
We will fail again, and if you want to see it, subscribe and hit the bell. Thanks for watching. We'll see you next week.